Hello and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Lavinka. Today, we're going to talk about an assumption. Assumptions are a big topic that have come up in today's mortgage world. And quite simply, an assumption is you taking over the terms and conditions of a mortgage that someone else originally took out. And then you will now pay that for the remainder of the term with no changes whatsoever. Mandy, why is everyone talking about assumptions right now?
So, the big reason that people are talking about assumptions is honestly interest rates. With interest rates, being low in 2020 and 2021, lots of people have interest rates of twos and threes, maybe even a one in there somewhere. So those rates were obviously very attractive. And so buyers are looking at rates now going, wait, what? What's going on here? So one of the selling advantages some sellers have is they can market their home if the mortgage they have is assumable for someone to be able to assume that mortgage. And the nice thing about being able to do that is you can then take over their interest rate. You take over the terms of the loan. So let's say they're, 3 years into the loan at an interest rate of 3%, you're going to take that over. You're now going to have 27 years left on the mortgage that you're going to pay. You're going to credit qualify for that payment. So you're going to speak with the person that's holding the loan at that time and get all your information into them to show that you can credit qualify for the loan. And then assuming that you do, they will then approve the assumption based on that. So that's one of the big advantages is the interest rate. Also, the fees sometimes can be a little less because you are just doing an assumable mortgage. You're not doing a full-blown mortgage like you would when you're coming in to see us. And so that can definitely help as well as cost, fees, rates, and everything. So those are a lot of the advantages, but I am sure there's some disadvantages as well. So maybe you can fill us in on that.
There sure are. So it sounds really, really good, and it is really, really good. However, one of the disadvantages that you have to take into consideration is the equity that the current mortgage holder has. So there's a good chance that they've had that mortgage for a few years. They may have put a larger down payment down. And say, for instance, the mortgage has a balance of $300,000, but they would like to sell the house for $400,000. So what we've both mentioned already is you cannot change the terms of that mortgage. So we can't simply increase the balance. So at this point, yes, you can assume a $300,000 mortgage, but they want to sell the place for $400,000. We now have a gap of $100,000.
So I'm coming up with $100,000.
So that means you have to come up with $100,000.
This assumption was sounding so good.
It sounds really, really good, but that's at the point where it gets a little bit sticky because that means that you would need to simply write a check for $100,000 at the time of closing. There's really not too many people, if any at all, that will offer you a second mortgage for that additional $100,000. So that's the big thing you need to watch out for on an assumption is what is the current balance of the mortgage of the original terms and how much the place is currently being marketed and sold for.
Conor, I did want to go back to one thing about an advantage that I meant to cover. And one of the other advantages of having an assumption is honestly in a divorce situation. If the mortgage is an assumable loan and you and your spouse are splitting, but one of you wants to keep the house, and especially if you're sitting on a really good interest rate right now, one of you can go in to the servicer, and that's who holds the loan at the time, so the person you're making the payment to, and you can show that you credit qualify for that based on your income. And assuming that you do, then the co-mortgager will be released from that loan. And then you can then take over that loan based on the terms and conditions that you had originally. And the other person is now no longer liable for that mortgage. So that's another great opportunity for an assumption, or even like a family member.
Sure.
Maybe, you've got your mom and dad, or they want you to take over their home, or vice versa. You've got some type of family situation going on. That's another great opportunity for somebody to be able to look at assuming a mortgage. and not necessarily having to come up with a down payment because of that as well. So there's another couple good advantages that I just wanted to mention when it comes to an assumption, not just when you're going to buy from another seller.
Okay, so now that we've established what an assumable loan is, now how do we go about finding out if a loan is assumable? On your original paperwork for your closing disclosure, there will be a part that will say that if the loan is assumable, that is going to be made at the time of closing for your loan. Once that loan is closed, that loan will forever be assumable or not assumable. Now, what type of loans are assumable? Any loan that is insured by the government, an FHA loan, a VA loan, or a USDA loan, commonly called a rural development loan, those are always going to be assumable at those original terms. And one thing to note about a VA loan is a non-veteran can actually assume a VA loan. It's not very common, and the veteran's original entitlement will be tied up. But if you see something that says that a VA loan is assumable and you're not a veteran, that is something that you can pursue. Finally, there are some state bond programs that do have assumable features to their loans. And so it's really important to look at that original paperwork to see if it is assumable and not assume that the loan is assumable. So the next thing that we'll talk about is how are we going to go about doing that if we do decide we are going to assume that loan?
Absolutely. So if you determine that the loan is assumable and, Connor gave you all the great options, of course, if you can't find any of your documents or you're just having a hard time, call whoever helped you get the loan. They can also help you with that as well. So how are you going to go about doing the assumable is you're actually going to call the servicer. The servicer is the person that the mortgagee pays, but the person that holds the mortgage is the one that pays to the servicer. So the servicer is the best place to start. If you're looking at a property that's listed for sale, I would reach out to your realtor, and then your realtor can reach out to the seller's realtor and get that information and then get you in contact with the servicer. And generally, what they're going to do is just like you would when you come in to get pre-qualified with us, they're going to review your income, review your assets, they're going to pull credit, and they're going to make sure that you qualify to take over that payment because that's the whole point is they need to make sure that you have the ability to pay. So you're going to, once you complete the qualification, they determine that you qualify, then the assumption will be complete. The person that currently holds the loan will be released of any liability, and then you will now take over that loan and take over the terms with the payments and everything as well. And you will continue with that current servicer until the end of the loan or something changes with that servicer and your loan is sold to somebody else.
Excellent. We hope we shed some light on assumptions today. If you have any questions about it, always feel free to email us at podcast@residentialmtg.com. But until then, see you next time. This podcast is sponsored by Residential Mortgage, LLC, NMLS numbers 167729, 196, 576, and 1820404. Equal housing lender.